Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
In this lesson, we will examine the subject of conflicting interests within the practice of accounting. Although the phrase conflict of interest invokes general ideas about a client's best interest, there are specific guidelines that precisely define what a practitioner must avoid when representing a client. There are three basic circumstances under which a practitioner may face a conflict of interest when representing a client. First, a conflict of interest exists whenever the representation of one client will be directly adverse to another client. Second, a conflict of interest exists when the representation of a client will be limited by the practitioner's responsibilities to another client, the practitioner's firm, or some other individual. Third, a conflict of interest exists when the practitioner has some personal interest in the client or the client's circumstances. It is very important when deciding to take on a new client for the practitioner to look for any possible conflicts that may arise from representing the client. In certain cases, it is possible for a practitioner to represent a client even if one of the previously mentioned conflicts exists. As long as the representation is not prohibited by law, and as long as the practitioner reasonably believes that he or she is able to provide diligent and competent representation to any and all affected clients, the practitioner may choose to represent the client. In cases such as these, the practitioner must inform all affected clients of the conflict. Each affected client must, within 30 days, waive the conflict of interest and give informed consent in writing. It should be noted that in cases like these, copies of the written consents must be retained for at least 3 years from the date of conclusion of the representation of the affected clients.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.